Evening, friends. So today we have this most awaited session, which is the analysis of the Finance Bill 2022. But before we start off with anything further, let us first pay respect to our ICI motto and by placing our hands on our heart.
य एष सुप्तेषु जाग्रति य एष सुप्तेषु जाग्रति कामं 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 कामपुरुषो पुरुषो निर्मिमाणः निर्मिमाणः तदेव शुक्रं तद्ब्रह्मा तद्ब्रह्मा तदेवामृतमुच्यते तस्मिन् लोकः शतः सर्वे तदूनात्यपि कश्चन एतद्द्वैता 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 एतद्द्वैता.
So friends, as I said, today is the most awaited session of the year, which is the analysis on the finance bill. We are very, very grateful to our learned faculty for the day, CA Gautam Doshi, for gracing this occasion and showing his willingness to share with us the knowledge that he has and the analysis that he has gathered on the finance bill. Just a little bit on, just a little take on the finance bill or the budget, that it looks like a new age budget where even the finance bill captures several evolving areas. The other thing that we see is also that the allocation has also seen a major change, a major shift, and there's a big bet which is laid on the manufacturing sector, pushing the economy. So that's another very big bet which is there in the budget. Then we have to see how it pans out, but definitely in the long run, it might be a good idea. In the finance bill, we see that there are several changes which have been brought about just to plug the holes which were there earlier. But of course, I don't want to say anything more. We have such a learned faculty with us. And I would just request our chairman first to share his thoughts on this occasion, and then with this we take it forward. I request Chairman Manish Gadia to please share his thoughts.
Thank you, Doshi Madam, and it's really a great pleasure for WIRC. Year on year, we are organizing this program, and last 3-4 years, we are getting a support of Gautam Bhai, and it's people and members of the region are really waiting to hear him out. And this time we have more than 5,000 registration for this program being on the virtual mode. So it's really great. Looking at the budget, it seems that more capital expenditure has been planned. The capex increase is 35.4%. And now we are going to see the construction of 25.
I can't hear anyone.
National highways, cargo terminal, 4 logistic park, 8 ropeway project, and 400 new Vande Mataram train. So all these are seeing that long-term perspective has been kept in mind. And as far as the tax is concerned, there are various challenges. Going to cover that. The changes what has been made in section 68, then the perquisite to the professional, that PDS part, which is going to impact all of us. Now the cryptocurrency and whether the digital assets like airline miles, credit card miles, various kind of miles we are getting or credit points we are getting on any purchases, that also whether have any impact or not, whether the clarity is required, more clarity is required. So there are various challenges as far as this budget are concerned and various things to be seen. And we have a learned person like Gautam Bhai. So definitely we will have a more clearer picture after the session, maybe in next 2 hours. So thank you very much to all the participants for joining. Over to you, Doshi madam.
Okay, so here now, every year when we have this discussion, WRC also releases our budget booklet. And I'm first of all very, very thankful to all the contributors who put in their, very means best of efforts to put this compilation together, and we've come up with a very nice, simple budget booklet which highlights all the the key issues which are there in the finance bill. Of course, the in-depth analysis is something that we will listen to now. So we release this budget booklet on this platform. So I'm very happy to announce the release of this budget booklet, and this is available with WRC. It will you can purchase this copy from WRC. You can place an order and get it. It's very, very reasonable. Anyway, so now I know the faculty for the day. Everybody knows him so well, and whatever he says is like letters written in gold. But still, I must do the the formality of requesting Arpit Kabra, Secretary WRC, to please introduce the speaker for the day.
Good afternoon, everyone. Am I audible?
Yes.
All right.
Yes.
Good afternoon, everyone, and really, it's a privilege to introduce Gautam Bhai, and we've been lucky enough to have his wisdom every time that direct tax or any other thing that taxation comes into picture. So we are thankful to you, Gautam Bhai, for accepting this invitation of ours and coming in and doing this. Of course, virtually, we would have loved to hear you in that open auditorium setup. But so moving on, friends, Gautam Bhai, fondly called Gautam Bhai, Gautam Doshi sir, a chartered accountant and masters in commerce for over 45 years in practice, advises various industrial groups and families, and also serves as an independent director on boards of leading public listed and unlisted companies, including Sun Pharma and Piramal Capital. Has an experience in wide range of areas: M&A, indirect, international tax, transfer pricing, accounting, corporate and commercial laws. Has been actively involved in conceptualizing and implementing a number of mergers and restructuring transactions, both domestic and cross-border, involving many of the top 20 listed companies on the BSE as those forming part of FTSE 100. A prolific speaker, Mr. Doshi has addressed several seminars in the endless institutes that he's already addressed, and many students like us whom he's been inspiring. Sir, may I request all of you to please put your hands together and please welcome Gautam Bhai in this wonderful gathering. Over to you, Drishti madam.
Now, without wasting any more time, I would request Gautam Bhai to please throw light on the finance bill, and the audience is eagerly waiting to hear from you, sir.
Good evening, everybody.
Good evening, sir.
Good evening. Chairman, WRC, Trustee, Secretary, WRC, ladies and gentlemen, I'm obliged to WRC for giving me this opportunity year after year, which enables me to A, study the finance bill, and B, of course, to share whatever little one understands of it with the audience. It's very difficult to understand very generally what exactly is being proposed through the finance bill. This year also, the budget as Drashti mentioned earlier, I think is in a sense path-breaking. The extraordinary investment on capex, the amount which we are going to spend, the manner in which it is going to be spent, and the way in which the economy is expected to progress, I think is very significant. And therefore, to that extent, the budget is great, is what one would feel. But on the other hand, when it comes to the finance bill, the position is a little more troublesome. It continues to reflect an approach which we will have to, to some extent, we have to work as a profession, as a public, to get the government to believe us and trust us. Because as things are, it seems like the government does not believe and trust us. Because the approach which one finds in this is one of mistrust to an extent. It is an attempt at times to punish, like the additional tax. It's petty in areas, like for example, the amendment on section 201 or 206C, where all that the government is saying is, if we pass an order, you must obey it. But in any case, you must obey the order. You don't need an amendment to say that. And yet they are saying this, which clearly shows, and that too on what? On a matter of computation of interest on amounts in default, not even on the amount in default and its payment. So something which is in that sense meaningless, something where the act is being used as in the past, even though we have been told that is no longer the intention of government. We have consistently been told that now the Income Tax Act is meant to be for the income tax and not for other purposes, but continues to be used for other purposes. For example, section 37. What are you really trying to do? You have about 7-8 pages of the explanatory memorandum telling you what the Medical Council of India is saying is not perhaps being observed by the pharma companies and by the doctors. The Medical Council is dealing with doctors, not with pharma companies. But that's what the government feels. It's for the Medical Council to enforce their law. They have enough power. They are a highly powerful regulatory body which governs the profession. But instead of that, the Income Tax Act is being amended to try and govern that. Or take the sections which are being introduced. What are the potential difficulties in implementing them? Again, no real attempt is being made to deal with that. Take a section like 194R or 194S. You have to deduct tax at source on a benefit or a perquisite, whether convertible into money or not. Something on which there has been consistent litigation, and till now, in a sense, there is no clarity as to what exactly this phrase covers. Going by the Supreme Court's decision in Mahindra, it cannot cover cash payment. Going by some other decisions, there is no clarity on what is a benefit. But the Supreme Court accepted that an interest-free loan is not a benefit, is not chargeable under Section 17. The Act was then amended to make it chargeable. That's another matter. So what exactly is a benefit or perquisite, whether convertible into money or not? It's fine for an assessing officer to assess it. Is it fine for every person who's dealing with others who are also in business to imagine whether what he's doing amounts to a benefit to the other man, and should he therefore deduct tax on it? For example, if he's buying goods worth 100 at 90, because you give a discount for selling the goods. Is that 10 rupee a benefit to him? Undoubtedly, it is a benefit because you are giving a discount which you have not given to anybody else. On the other hand, you are giving a benefit because you need to dispose of your goods. You have to sell them and it's part of your business. Would you have to deduct tax at source on that? I don't think one can answer. The better answer is no. Such a benefit or perquisite is covered in the normal computation of income of the buyer. If he buys at 90 and then carries out his business, he is bound to show the additional profit of 10 and pay tax on it. It is not a benefit or perquisite chargeable under 28(4) and therefore not something on which one should deduct tax under 194R. But I'm not sure that this is necessarily the correct interpretation. What I'm trying to say is such complex sections and that difficulty is left to the assessee to resolve. And the continued attempt to do retrospective amendments. Last year, you had 3 retrospective amendments, if one may put it that way, dealing with goodwill, dealing with 50B, and so on. And I did not see the business community and the profession protesting enough in respect of those, in a sense, retrospective amendments, because after the year was nearly over, after 10 months, you are told that you will not get depreciation on goodwill. Or you are told that your computation of a slump sale price will be done in a different manner. And that continues this year. You are now told after 10 months are over that under section 37, your disallowance will be very different from what it was at the beginning of the year. Or you are told that on an item like cess, you will face a disallowance. In fact, this is from 2005 onwards. So a government which has told us that we will not make retrospective amendments and told us through Parliament, made that observation continuously. So it's in a sense a solemn word which the government has given. And they go back on it by saying it's not retrospective because it applies to the income of the current year. But if you make a law in respect of the income of the current year, 10 months after the year is over, or 10 months in the year, then undoubtedly it is retrospective. So it is something which one has to consider. So the approach in the finance bill continues to be one which, with great respect, one may say, disregards the assessee and the public as somebody who is bound to accept and follow whatever we tell them, who does not really have a voice. But anyhow, that's what we have. We do have a few petty benefits like the COVID and the IFSC benefits, but those are not really worth talking about. And the other point, which we have been consistently saying, is this budget, this finance bill also touches, as usual, almost 50 subjects, more than maybe 50 subjects. If you need to touch 50 subjects, then it should be a Taxation Laws Amendment Act, which can be separately budgeted in Parliament, dealt with, and on which public and MPs will have time to react. Trying to do it in the finance bill effectively is doing it on the barrel of a gun. Because as an MP, as a Parliament, you cannot question the provisions of the finance bill, because if you do that, you are taking the risk of questioning the government itself. The government can fall if the finance bill is not passed. So really, you have no choice but to pass the finance bill. And if in that process, you are covered with another 50 amendments, some of which are good, some of which are bad, some of which are indifferent, there's nothing which you can do about them. You have to accept them. That is the difficulty. It has to come. This level of amendments have to come through a separate act. They should not be coming as part of a finance bill. The government, the speech of the finance minister keeps on saying that the government is committed to, and that it is repeated this time, a stable tax policy. A stable tax policy can't have 50 subjects which are amended every year. That's not a stable tax policy. Merely because the tax rates are consistent does not make it a stable tax policy. The computation of tax is as important as the tax rates. So therefore, that is another area. And I'll come back to it. The other point which the finance minister tells us, that they trust assessees, and the whole purpose of the finance bill is to build the trust between the government and the assessees. And as we discuss each of the amendments, we will see whether that is really being achieved or not being achieved. But coming before now, turning to the specific provisions, and I think the first thing which we must deal with is the one very welcome provision, which is the exemption being given for payments arising out of COVID, the illness, and the demise of a few, not a few, but many of us who have been unfortunate in that process. It has been, the pandemic is an unfortunate event, it's a difficult event, it has created tremendous difficulty for the country, and amongst the few alleviating features is the fact that in a number of cases, either employers, either government, either trusts have come forward and helped people who are suffering, who are in difficulty, either by meeting their medical expenses, and where unfortunately it has led to a demise, by trying to compensate in money terms. Money can never really compensate for a life, but trying to compensate in money terms for the people who have lost their lives. And government had said earlier that these payments would be exempt, and that's exactly what the section is trying to say, is making clear by amending two sections, 17 and 56. Effectively, there are two parts to it. If there is a reimbursement of medical costs, and I'm using the word reimbursement, but medical treatment costs, then that is exempt. If one has received that, and it could come from an employer, it could come from other sources. And the second part is, if somebody has suffered a demise, then any family member who has received assistance as a result of that can also claim exemption on the amounts received. What is received from the employer is exempt without any limit. What is received from others has a limit of 10 lakhs. But the exemption for what one receives from charitable trusts continues. So if those others are charitable trusts, then this limit of 10 lakhs will not apply. If that other is a non-charitable trust, somebody other than a charity, then one still has this limit of 10 lakhs, which will apply. In either case, a time limit has been introduced, perhaps correctly so, that this payment should be within 12 months of the demise. Because you want to make sure it's a genuine payment for this purpose. It is not some other payment which is being camouflaged as a payment for COVID. And to that extent, this is absolutely correct. But on the other hand, in a number of cases, one has found that payments may be deferred. They may start within that 12-month period, but there are employers who have said, we'll continue to pay salary for the next 10 years. We'll continue to pay the salary which that person would have earned for the rest of his life. I mean, these are also types of payments which people conceive. One of the major reasons why that is conceived is that a lump sum may get used up, may get wasted, may even get effectively confiscated by others, non-family members or family members, and may not, therefore not reach the right people. A recurring payment will make sure that benefit is available. These recurring payments would, however, if they amount to annuities, and to my mind they would amount to annuities, would then be taxable. So therefore, if they are recurring payments beyond 12 months, those will continue to remain taxable. And as far as this is concerned, you have a definition of family, which is standard: spouse, children, and parents, brothers, sisters, only if they are dependent. But then the person paying can easily pay the spouse or the children, where that rule about being dependent is not brought in. Because dependent is a very difficult word to construe. It's not very difficult, necessary to construe in a number of situations. Therefore, one is not really bothered about it. But if you are concerned with an exemption of this nature, you may come into conflict to decide who's dependent. A father who's getting a pension is technically perhaps in a position to look after himself. But on the other hand, his quality of life, his lifestyle may be very different if his son is alive and is also earning a salary and is contributing to the household, as compared to what he can do if he has to live only on his pension. Would you say he is dependent? If you say he is not dependent, then the payment made to him by the employer will become taxable. If on the other hand you say he is dependent, it will not be taxable. Technically, I don't think you can say he is dependent, because he is getting a pension which perhaps is enough to pay for a basic quality of life, though not for the lifestyle to which he is used. So things like this are going to require further guidelines, further notifications, further clarifications, because I don't think the intention is to really tax in all such cases. So perhaps if they had not put in the condition about parents, brothers, sisters being dependent, it would have been far better. And perhaps even now that condition can be deleted, because you don't really want disputes in an area like this. The major change is the next is relating to virtual digital assets, a new concept, a totally foreign concept till a few years back, but something which has now become a part of life. One was not sure till some time back whether the regulators and the government treat this as something which is legal or illegal, and will to consider this type of assets and dealing in them and transacting in them as desirable or undesirable. At some stage, the Reserve Bank indicated that it would ban. At some stage, the government indicated that it would perhaps ban such trade transactions. Even now, there is an indication that there will be some regulation of these transactions, that we will have a bill which will explain what are virtual digital assets and how one can deal with them. What type of dealing is permitted and what type of dealing is undesirable. The question is it speculation? Is it something which is not good for the economy because you are dealing with something which perhaps has no inherent value of its own and just passing entries and making transactions? And therefore, is that a desirable thing? On the other hand, it's an innovation which will make life easier. A digital currency is so much easier to use than a physical currency. And therefore, it is an innovation which is something which has to be brought in. It is an innovation which provides for security. A virtual digital asset obtained by cryptography, by the blockchain concept, is something which can't be forged, something which can't be duplicated, something which can't be perhaps even stolen. though hacking is not impossible but very difficult. So therefore you are now talking about an asset in which respect of which you are not worried about it being lost, stolen, taken away, or copied and somebody else using a duplicate thereof. So it's a very desirable thing. So it's both, and that is why government is considering what type of regulation to bring in and how. But in the meantime, we now have a definition, at least for the purpose of the tax law. The definition is not without difficulty. It is a very wide definition. It talks of 4 things: information, code, number, or token. One doesn't, being a new concept, being a concept which one was not used to, one doesn't fully understand the difference between these and in what situations which one will apply. But all of them together would go into the digital asset. A question has been raised, for example, also, do you need both the words virtual and digital? The definition section refers to virtual digital asset. The taxation section refers to virtual digital asset. But the body of the section refers only to digital asset. And it's enough to refer to digital asset. Whether virtual is required or not is itself an open issue. But so we are going to have this. I think a lot of these issues which one is concerned with in the section will get clarified through notifications. Because effectively the section, the definition says, a virtual digital asset is comprised, as I said, of one of these 4 things: information, code, number, or token. When it has one of these 3 qualities, it is either a digital representation of value, or it is a store of value, or a unit of account. If it is one of these 3 things, in addition to being one of those 4 things, then it is a virtual digital asset, not otherwise. But what you are further told is, government has the power to notify things which are virtual digital assets and to notify non-fund tokens as virtual digital assets, and the power to notify those items which satisfy this definition but are to be kept out. A question has been raised by a number of people. For example, this definition, a token which has got inherent value, may be answered by the credit for an airline mile. It is a token. It has got inherent value because it would entitle you to travel or entitle you to obtain an airline ticket if that is what the airline provides. Is it really intended that transactions in these airline miles are also to be charged? Till today, they have not been charged, by and large. And I'm now doubtful whether they are intended to be charged. They are on personal account. If they make a significant profit, I think they would be chargeable. They would be chargeable under 45. And if they don't make a significant profit, they would not be chargeable. But I'm not sure that one is intending to charge things like that through this amendment for virtual digital assets. One really wants to charge what are called cryptocurrencies and not really most of the other things. Things like Bitcoins and Ethereum and things like that, and not a variety of other assets. So it is the notifications which will tell us really what is included and what is excluded. And I'm assuming that we will have notifications and guidelines which will take us down this path. And because this part of the section is coming from next year, we have time enough to wait. I'm clarifying this part of the section because a transaction in a cryptocurrency is a transaction. And if that transaction results in income, even today it is taxable. And if that transaction results in a loss, even today it should be allowable. How it should be taxed, in what manner it should be taxed, The normal provisions of the Act, I think, are adequate to cover it, but they are not adequate to cover all the special features of such a currency, and that is the reason why we have a special section coming in for it. But otherwise they are there. So if it is a trading transaction, if one is a trader in currency, it would be business. If one is an investor, it would be a capital asset giving rise to a capital gain or a capital loss. It's a question mark in my mind whether one can ever be an investor. Because one of the traditional concepts from a tax law has been that for it to be a subject matter of investment, for it to be a capital asset and not an asset acquired for trading, not an asset acquired for business, it must be an asset which you hold either to earn an income or to use in the course of your lifestyle, for example, a house, a car, etc., or a share from which, or a loan from which you're going to earn interest or dividends, or something which gives you pride of possession, like a painting, something which is a store, like gold at times, because that also gives you pride of possession along with that. But something which you buy only with the objective of reselling is perhaps intended to be a trading asset and should be dealt with as a trading asset. If that view is taken, then perhaps it can never be a capital gain. But after considering the definition as introduced or proposed to be introduced by the finance bill, it's very clear, I would think, that this is not the view, and luckily for us, that this is not the view which is shared by the government and by the regulators. They have referred to the virtual digital asset as being a source of accounting, a mode of accounting for investments. They are treating it as a possible source of investment. They are talking about a cost of acquisition. They are talking about income arising from a transfer of a virtual digital asset. And therefore, the treatment suggests that the government and the regulator are willing to treat it as a capital asset and not necessarily as only being stock in trade, as only being the subject matter of either a business or an adventure in the nature of trade. So that problem may not arise. You should be able to claim the income either as business income or as capital gain. But even today's income will be taxed, tomorrow's income will be taxed. As far as tomorrow's income is concerned, after April 23, the one major difference, as of April 22 onwards, taxable in April 23, the one major difference which will arise is that today you have to consider which head of income is applicable. Because only then can you compute the income and you can apply the rules of computation relating to that head of income, relating either to business or to capital gains. After 115 BBH comes into force, thereafter you don't have to worry about the head of income. Irrespective of the head of income, the same income will be taxed at the same rate, 30%. So the head of income goes away. More and more, we are seeing this trend. A lot of headless income, if one may put it that way. The concept, of course, originally of Section 14, and it continues to be there, is that income must fall under one of the 5 heads. If it is not one of those 5 heads, it is not taxable. So something which is, for example, could be income from house property, but is not covered by the computation provisions of house property, cannot then be taxed because it is not falling into any of the 5 heads. So that is the law. So it would be outside. Now we do have sections 115 B, BB, AB, up to now 115 BBI, all of them dealing with different forms of headless income. A charitable trust having extra income under 115 BBI will be taxed there at a fixed rate. A cryptograph virtual digital asset yielding income will be taxed at a fixed rate under BBH. So more and more this concept is coming through, that headless income is being charged, or rather income is being charged without trying to classify it under a head. It's only for simplicity, only for convenience. But simplicity and convenience where 30 different items are to be taxed without a head, and then the rest is to be classified into heads, is also equally complex and difficult to comply with as trying to classify those 30 items into heads and apply the computational provisions. I think it would have been better if they had left it into heads, but they have not. They have taken it out of the head. One of the key features is of most of this headless income is that there will be no set-off of losses, and in this case, not even of expenditure, not just losses, except cost of acquisition. Cost of acquisition is going to remain there for a difficult area. Very simple, one would think if one is purchasing, the cost which one is paying for purchase. But what about associated costs, commissions? I think those would all be cost of acquisition. What about an exchange rate difference? If you are buying it in foreign currency, will that be part of the cost of acquisition? I think ultimately, yes, the cost of acquisition is what it finally costs your pocket in rupees. So even that should come in. So the cost of acquisition is allowed, all other expenses will not be allowed. That is the effect of what it says. And if you have made losses in business, you still have to pay tax at 30% on the income from virtual digital assets, because you can't set off other losses against this income. And if you have made losses on virtual digital assets, you will not be able to use that loss to reduce your business income or your salary income or your house property income. This loss will be useless. And because it is not allowed to be carried forward, it will virtually be useless for all times to come. It's a dead loss. Whether that is called for, whether that punishment to make it a dead loss is called for, is something which I think is an open question. One should perhaps go back. That yes, this is an area which needs regulation. But once regulated, the losses should be allowed. Should be at least allowed to carry forward and set off against income under the same item in the future, like you do with speculation losses. To totally disallow carry forward may be perhaps a bit too much. Some complex questions will arise about which head is this finally taxable under. It's not, as I said, material to the computation. It's not material to the computation of tax. But it is material if there are exemptions or exclusions from that head. Will those exemptions or exclusions also be applicable to this income? For example, can 54F be claimed on income from a virtual digital asset which has been held for more than 3 years? It will become long-term only after 3 years. The rules for shares, securities, some assets which make it within 12 months, some immovable property which is within 24 months, all will not apply. The 3-year rule will apply. It will be long-term at that point. But let's say you have been holding a virtual asset for more than 3 years, and you then make a profit on it, say. Can you claim that a part of it is exempt, a part of it is not chargeable, because you have reinvested that amount into buying a house and claim an exemption under 54F, or because you have invested a part of it in putting it into certain bonds which are prescribed or specified, and therefore you are exempt under 54E? Can you possibly claim the exemption? I think the answer seems to be yes, if it is capital gains. And as I said, the way one reads the finance bill, it seems to accept that it can be a capital asset, giving rise to capital gains, and consequently, it should be possible to claim this. Does it form part of gross total income? This income taxable at a special rate, but is it part of gross total income? The answer again perhaps is yes. And if it is, then it will help you in claiming deductions. For example, the 80G deduction is linked to the quantum of gross total income. And therefore, if it is part of your gross total income, the 80G deduction can be higher to that extent. So therefore, it is headless income, but not really headless. Only thing is you have to discover the head. And after discovering the head, you can claim certain benefits if they are associated with that head. 56(2)(10 will also apply to this income. Namely, if somebody gives a virtual digital asset to you, and if the total value of that gift is more than 50,000, then that will be taxable in the hands of the recipient. And gift will include an absolute gift or a gift in difference in value. A crypto asset worth 1,000 rupees given to you at 200 rupees is a gift of 800. So that gift will also be included. The issue is, what is the value? How do you say it's worth 1,000? That is going to remain a very difficult issue, because one understands that this asset has a very volatile valuation. Valuation differs from day to day and perhaps from hour to hour. And not being regulated, you don't have authorized stock exchanges where you can find the value, where you can know that this is the price which is quoted or listed for this item. So the price discovery is very, very uncertain. If you have 40, 50 different exchanges, which exchange will you use for the purpose of price discovery? And when you are talking 40, 50 only in one country, if you are taking the world together, then the number of exchanges is innumerable virtually. So how will you really determine the value of this asset? That's something on which again one expects to find rules. The difficulty is when it comes to section 56. Do they have the power to prescribe rules for this asset? The way in which the amendment has been made, because it has not amended the definition of property in the explanation to 56(2)(7, but has put it in the explanation to 56(2)(10, and the power to notify valuation rules is only there in respect of 56(2)(7 and not in respect of 56(2)(10 until government takes an additional power to notify valuation rules. We may not have valuation rules on this subject. I'm sure they will take that additional power. Until they take an additional power, they can give a guideline, and a guideline may become a basis which most people will be able to follow. There is a TDS on this income, and that's going to be very difficult also to implement. That's what I mentioned at the beginning. How do you implement a 194R in a matter like this, where sometimes you can't identify who is your buyer? You'll have to analyze contracts and understand. Are you selling to the broker selling to the exchange selling to the buyer? Are there 3 transactions? Are there 4 transactions? Or is it that you are selling and the buyer is buying and the others are mere intermediaries and they don't get property of that particular item in the meantime? How exactly does it move? The asset moves from your account, perhaps to the account of the broker, to the account somewhere in the exchange, to the account of the broker of the buyer, to the buyer. And if that is the way it moves from so many accounts, is the moment it enters an account, does it amount to ownership? Then are we saying there are so many transactions? Then will 1% have to be deducted every time? Therefore, in a one sale and purchase, will you really be talking about a 5% withholding or a 1% withholding? That's not very clear. Again, we will wait for some notification, some guideline on this aspect. See, in a normal stock exchange, it is clear. Your broker does not take ownership of the shares. He only receives the shares from you, passes them on to the exchange. The exchange does not take ownership of the shares. The exchange only passes it on to the buyer. So there the rules are clear. Here the rules are not clear. Because I also understand, I'm told that there can be variations in the pricing. In the sense that if you give it to your broker, the broker can add his brokerage and then give it to the exchange or things like that. Or he can recover. So it is not, if he doesn't have ownership, how can 100 become 101? Then the 100 should be passed through clean, and the fees and the brokerage should be separately charged. But here I'm told at times it is not separately charged, it's added to the value. If it's added to the value, then clearly it seems to be multiple transactions. So there is a TDS of 1%, which is going to be difficult. And the second difficulty is cases where it is paid in kind. If there is payment in kind, in the sense that a Bitcoin is exchanged for an Ethereum piece. Now in that case, you still have TDS, but you can't do TDS because there is no cash passing. Because there is no cash passing and you can't do TDS, you are now told that you need to ensure that tax is paid on the transaction. But how do you ensure that? Because tax is payable at the end of the year when income is determined and the return is filed, not till then. Whereas the transaction is happening today. And how do you determine the amount of tax which is really payable? Is it meant to be that you have to ensure that 1% is paid? Or do you have to ensure that the full tax is paid? The full tax is 30% on the profits. But on the profit, it depends on the cost of the seller. One doesn't know his cost. How does one ascertain his cost? And how does therefore one ascertain how much tax he has to pay? There is no real clarity on that. It's a difficult proposition. I'm sure there will be some modification. They will have to clarify this. There is a similar provision today in the context of lotteries. If you win a lottery in kind, you win a car. You can't receive the car till you have paid the tax on the car. And today, the way in which it is implemented is the full tax is payable. Because the TDS in any case, in that case, is on the full tax amount. So you have to try and work out what is your total income. You have to work out the full amount of tax at 30% or 33% or whatever be the rate, and then pay that. So that is the rate at which it becomes payable there. If that is true even in the context of virtual digital assets, then in terms of cash flow, life will be much more difficult because the entire tax will be paid in a number of installments over time if one keeps on exchanging as opposed to selling and encashing. It will practically, I don't see how it's really going to work. Then I thought that this being a new provision, we should try and understand it. I have tried to deal with some of the aspects of it. Turning to the other provisions, and we have a number of amendments, as I said earlier. Each one of them, one could debate at almost the same length of time, unfortunately, because each one of them has peculiarities. But perhaps if we can just deal with the key aspects, that's what I will try to do. The next major change is, for example, material to my mind only because they have made it retrospective from 2005. Principally, I think what government is trying to do is right. Health and education is really part of income tax. And therefore, if income tax is not a deductible expense health and education cess is not a deductible expense. Principle. But is that the truth? If you look at what the CAG has said and the way in which it is dealt with, tax goes into the Consolidated Fund of India. Cess goes into the Consolidated Fund of India, and thereafter there is a requirement on the government to take it out and keep it in a separate fund. It is more like something which the government receives in trust. I am effectively donating to the government the quantum of cess as a trustee, and the trustee is supposed to spend this amount of cess for health and education and nothing else. So this is a trust which you are creating. Is it really a payment of tax? That is the question. And there is no clarity on that. Based on the board's own circular and this concept that cess is different from tax, and the fact that the word cess was included in the 1922 Act for the purpose of disallowance and specifically excluded when the 1961 Act came in the section dealing with disallowance, the view taken by some high courts, Bombay and Rajasthan are referred to in the explanatory memorandum, was that it is allowable because the disallowance section does not refer to cess. The board circular says it is allowable, and if cess is different from tax, then it is allowable. As to whether it is different, as I said, two views are possible. Yes, it is computed on the basis of your income, but it is not necessarily a tax. It's a compulsory donation to government to create a trust for health and education, as opposed to a tax. And the amendment which has been made to disallow this also, I think, leaves a little to be desired, because it says cess on such tax. It does not refer to and borrow the language from 40 subsection 1 subsection small Roman 2, which would have required it to refer to a cess computed on the basis of income, taxable income of that assessee, or income from business of that assessee. That cess would have been disallowed under 41(2). This says on such tax, will it still fall to be something disallowed under 41(2) is another gray area which will arise and give rise to some additional litigation. The intention being clear, if at all that litigation comes up, you will have another amendment saying this cess is to be disallowed. So the intention is clear. But take the language which the explanatory memorandum has used for the purpose of justifying this amendment. And I'm only, it may not be right to do it, but I still feel a little concerned with the type of language used, and that's why I'm referring to it. What we are told is, amongst other things, the interpretations of two high courts and various ITATs are against the intention of legislature. That's the first thing. How does one know the intention of legislature? Does the officer drafting the finance bill today know what the intention was in 1961 when this law was enacted? Did he meet all those members of parliament and ask them, what was your intention and what did you have in mind? Certainly not. So therefore, by intention of legislature, he means what he thinks should have been the intention of legislature in this draft. Now, who is supposed to interpret what the legislature has drafted? The executive, the legislative body, or the judiciary? I thought we were clearly having three parts to our government: an executive, a legislative body, and a judiciary. The legislative body has the right to draft, but once drafted, what it means is left to the judiciary. And if the legislative body has not been able to express what it means, you can't blame the judiciary for saying that you have gone against the intention of the legislature. You say that this is what we think today is a desirable route, perfectly okay. We think that this type of cess should not be allowed because it is contrary to the general concept and the way in which incomes is computed. It is not something spent for the purpose of earning income, and therefore it is not something which is intended to be an expenditure. Perfectly okay. But you can't use this. And then you go ahead and say that not only it is not in intent, against the intention, against, you are using a word as strong as that, are against the intention of legislature, as if the ITATs and the high courts have deliberately flouted the legislature. And then you say, I'm not in line with the judgment of the Honorable Supreme Court. So is the Parliament or the executive now interpreting law and deciding what is in line with judgment and what is not in line with judgment? Are they doing this? Or is it something which is left to the judiciary again? So therefore one has to consider. Unfortunately, I'm referring to this, as I said, to come back to what I said at the beginning, the approach behind the finance bill. If you accept that assessees, that public act honestly, then I think you should not be putting this language. If you have made a mistake in drafting, or if your draft does not bring out clearly what is to be allowed or disallowed, and if as a result courts have the right to interpret, they have interpreted, you are welcome to change. But not by saying that what you have done is wrong. You are effectively trying to say that public and assessees who make this claim are not acting fairly. With great respect, I think that assumption is wrong. And that is the assumption which is underlying this finance bill. This phrase, not in accordance with the intention of the legislature, I believe, is used at least 6 to 7 different times through the explanatory memorandum. So this is the difficulty. The approach is a little misunderstanding, but anyhow, it's there. As I said, on this particular amendment, at least on principle, I think it seems to be right. But on the other hand, taking the amendment to section 37, the explanation, which is another amendment which has again similarly been done in order to make the intention of the legislation clear, much better language, than to say the decision is against the intention of the legislature. Here at least polite language is used, that we are trying to make the intention clear. And of course, intention is something which nobody knows, but even then they are making it clear. But then they have added few other words, and to make it free from any misinterpretation. Who is misinterpreting? Misinterpreting is virtually trying to again blame the courts and the tribunals for taking a view. Because you are saying misinterpreting. Effectively, what you are saying is you are not reading the law correctly. You are not understanding the law correctly. And that's the business of the courts to understand. You can't say that they are misinterpreting. If so many courts are taking a certain view, you can say, we think it should be something else. Our intention is something else. And to make our intention work, we are changing the law. That's perfectly okay. Anything more than that, with great respect, is wrong. But that's what the explanatory memorandum does say. Then what does it say on section 37 now? What is it trying to say? Earlier, there was an explanation which was added, which said that you will disallow any expenditure which is for the purpose of, or which is an offense under the, or which is prohibited by any law. for the time being in force. And at that time, if you go back and see the explanatory memorandum, the indication was that there is extortion, there is blackmail, and people are being compelled to pay that. And that payment is something which was felt is not justified, should not be allowed as an expense. It was proposed to be disallowed. That was the offense which was in the minds of the draftsmen, because at least going by the explanatory memorandum, that was in the minds of the draftsmen at that point of time, or in the mind of the legislature. Clearly, the Medical Council of India's rules came much later in 2002, and this particular amendment, which they believe is being misinterpreted, came much even later in 2009. So it could not have been there on the day when the amendment was made. It could not have been there on the day when the explanation was introduced, because it did not exist at that particular point of time. We are now being told that this disallowance will apply not only to something which is an offense under Indian law, but also to something which is an offense under foreign law. Again, government's prerogative to allow or disallow expenses, fully understood. But again, one wonders why. Businessmen are doing business. If it is an offense of Indian law, it's contrary to your public policy. And therefore, you should disallow that. You should not allow that expenditure to be allowed. But if it is contrary to the policy of some other country, should we be enforcing it? Should we be disallowing it? That is something which one has to consider twice. But now foreign law has also been brought in. Foreign law may be necessary in the context of business, the way things are done. I mean, one doesn't know. For example, the leading case where foreign law was discussed is one of Mylan Laboratories, where they finally settled a patent dispute. It was their view that they had not violated the patent. It was the view of somebody else that they had violated the patent, and therefore there was a violation of the law. They settled it. The courts allowed that expenditure because even if it was a violation of foreign law. It was not a violation of Indian law. And that was the reason to allow. Should this expenditure really be disallowed for somebody who's doing business, who's earning income from selling those medicines, and which income you are taxing? It's an area which one needs to consider. So that is one. The second part of the disallowance is going to be now an expenditure incurred to provide a benefit or perquisite to a person who's whether carrying on a business or not carrying on a business. So it doesn't matter whether the recipient is in business or not. To a recipient, it must be for the purpose of giving him a benefit or a perquisite, and the benefit or perquisite must, and the acceptance of that benefit must be in violation of law. Up to that is fine. It goes on to say not only violation of law, but rule, regulation, or guideline. Two things. If you pay a bribe to somebody, I think it would be caught under the first explanation for any purpose which is an offense, because it's an offense under the Corruption Act to pay a bribe. You don't need the second clause to deal with that. But if you pay a bribe to the purchase officer of a customer, and the purchase officer is a private company and not a government company and no public servant, and that's your way of doing business, and the consequential profit is being charged, should the expenditure on the bribe be allowable? After all, either you don't charge the profit and say, this is bad profit, this is tainted money, I don't want it. I don't even want a part of it. Or allow that expenditure because no public policy has been violated. But if you say rule, regulation or guideline, you will now not allow that expenditure because that officer is bound to be the one who accepts it, violating some rule, regulation or guideline. His internal rule, regulation, guideline, not statutory, not in any act, not in any rule laid down by any authority, by any regulator. It's just some internal rule, regulation or guideline which is getting violated. And that is something which is going to be very, very difficult to find out as to when it is violated or not. Company has a policy saying no employee of ours should accept a Diwali gift which is valued at more than ₹1,000. Number of companies have this policy. And you give a Diwali gift of dry fruits, but unfortunately that year they cost 1,100. Is that to be disallowed? Because it violates the guideline, and the acceptance of the guideline, acceptance of that Diwali gift is in violation of the guideline. Imagine the number of cases which will come up in trying to interpret this clause and make this disallowance. And the reason why I say the rule, regulation or guideline is not law, is not statutory but other, is that law is defined under General Clauses Act. And under General Clauses Act itself, law would include rules, regulations. So you don't need to separately refer to them. So if you separately refer to them, you are now referring to some other rules and regulations, some other guidelines. So those are all private guidelines, not statutory, not from any authority or not from any regulator. Disallowance of these will become very, very difficult. And finding out when it is a violation, when it is not a violation, is going to remain a gray area. For example, let us say the guideline says he is allowed to accept, the only condition being that he must inform his boss or he must inform the manager that he has received this gift. It's not prohibited. Is it a violation of the guideline? Now you have to find out whether after accepting the Diwali gift, he told his manager, he did not tell his manager. How would you know on that day whether it is in violation? And the third disallowance now is going to be of amounts paid to compound an offense. Again, a gray area. We are using words which are very difficult to understand. Compounding of an offense would mean that an offense is established, is how I would understand it. That means an offense has been committed. Somebody has come to the conclusion that it is an offense, and then you are compounding it. But if you pay consent terms, settlement terms for something which is not finally established to be an offense, but which could be an offense, which may not be an offense, then is that compounding fee to be disallowed? Because the explanatory memorandum refers to perhaps such fees as the basis for, in a sense, providing for this. Would you really disallow such expenses? Because here is a case where the regulator who is accepting the fee is saying that it is without acceptance or denial of guilt. He is saying, I'm not saying you are guilty, I'm not saying you are not guilty. I don't want to proceed further with the case, you don't want to proceed further with the case, pay me so much, and that's the end of the matter. In that type of situation, is this compounding fee to be disallowed? If it is a fee paid post committing an offense, which is established, it's a different matter. Establishing an offense is a very, very complex subject. Goes through courts, not one court, but 2-3 levels normally of any court. We have a tribunal decision where offense was established. In the sense, the first order was against the assessor. by that particular regulator, SEBI, who said this was an offense under so and so rules, and consequently you are liable to penalty. The assessee in that case filed an appeal against that order. He did not accept SEBI's order. In his view, the offense was not an offense. He thought he had not violated the SEBI regulation. But then he went and compounded it by telling SEBI that forget it, whether I have committed an offense, you say I have, according to me, I don't have, I have not. Let's not argue all this. I will pay you this fee and let's close this case. And SEBI agreed to do that on the basis that whether he was guilty or not is uncertain. It would not be covered by this. So then what exactly, how many actual compounding amounts will come through? Virtually none. And secondly, assuming it is a compounding amount, actually, should it be disallowed? What is compounding? Why is it there? The whole idea is it's in accord with public policy. You don't want unending litigation. You don't want people to be troubled. You don't want authorities to have the difficulty of having to go through so much litigation. You want them to do their job. You want people to do their job. And that is why the various laws provide for compounding. Compounding is something which laws consider desirable, not undesirable. If it is a desirable thing, because otherwise the law would not provide for it. And if the law provides for it as something which is desirable, then why should that be disallowed under the Income Tax Act? So, I mean, one wonders about all such things. This again is retrospective in a sense. It comes back for whatever has happened in the last 10 months. All of that could possibly get disallowed in this type of situation. And the other part of it, leaving aside all the other points, the logical corollary to it is the TDS provision which is coming up as a result thereof, which is actually enforcing existing 28(4). TDS on benefit on perquisite, benefit or perquisite of a business or profession. This applies only to business or profession. The disallowance, as I said, doesn't make a distinction whether the recipient is in business. The recipient, as I said, is an employee of a customer. All are covered. Anybody and everybody is covered if it is against a rule. If he is in business and he has received a benefit or perquisite, that benefit or perquisite arising from business, and that's an important word, arising from business, is taxable. It's an important word because it may come from somebody associated with business but may not arise from business. For example, LIC is likely to give the benefit of its IPO to all policy holders. And as a result, it may result in a benefit to them. The assumption is that it will benefit them. The assumption is that they will get it at a price which is below the price at which it will list, and they will possibly make a profit. That is the reason why it is being done. Now, those policy holders include LIC's own agents. Quite a few of them may also be policy holders. Almost 90% of them would be, if not 100%. So they will also get this benefit. Now, this benefit of perquisite, when he gets it, should LIC deduct tax at source? Because LIC has given him a benefit by giving him that share in the IPO at a price which is below the fair value. Technically, if this is what is intended by the TDS on benefit of perquisite, LIC must deduct tax at source on the benefit by the agents of LIC who get the benefit, not from other policyholders. So if 10 million policy holders get the benefit, maybe out of them 1 million are agents. They must pay the tax, not the others. That is what this, and therefore you have to find out and deduct tax at source. That is what this section seems to suggest. It's a gray area whether it is a benefit. To my mind, it is not taxable under 28(4) because it does not arise from business. The requirement of that section is it must arise from business. But 194R does not make that distinction, and therefore it may become something which is liable to TDS. We have to examine that. The second question which arises is, what is a benefit and when is it taxable? Is the ability to buy it below the market price a benefit? Or is a benefit something which you actually receive in kind? There is a lot of case law on that subject. The Supreme Court, for example, accepted that an interest-free loan is not a benefit. So in a sense, a saving and expense is not a benefit. There are courts which have accepted that a benefit which you cannot encash is not a benefit. So if you are allowed to stay free in a house, but you are not allowed to lease it out, you are not allowed to give it to third parties, you are not allowed to do anything else, it may not be a benefit. There are, in all such cases, specific rules under Section 17 which charge such benefits to tax for employees. But those are rules which have been made to make sure that all such benefits are charged. In the context of business, it may or may not be chargeable. Why would it not be chargeable? The point is, if you charge this benefit, you must allow me perhaps a notional cost of the rent which I would otherwise pay to carry on that business. You are allowing me free premises as a distributor to sell the goods. It's a benefit, but it's not chargeable, because if you charge this, then you must allow the rent which I would otherwise pay to obtain those premises. It's a part of the business. So what is chargeable is a benefit which does not enter the accounting of the business profit. This enters the accounting of business profit because I don't charge an expenditure for rent. So such benefits don't come in. If they don't come in, then they should not be charged. So 28(4) till now has been almost a dead letter. One has rarely come across assessments where amounts have been added under 28(4). And it is a dead letter because, as I said, if the benefit arises from business, almost invariably it is caught within the terms of the business. And if it does not arise from business, then it is not taxable. So what is the example of a benefit which arises which is going untaxed today? For example, you give free vacation to distributors. Vacation, that's a benefit. It is going untaxed because if you did not give him this free vacation and he paid for it, he could not have claimed it as a business expense. But instead of giving him a free vacation, you give him the same travel and hotel and all those costs for the purpose of attending a seminar by which you propagate your business. Then it is not a benefit. Because if you were not to give him this benefit, he would be able to claim the expenditure of attending that seminar. And it would be allowable to him as a business expense. So one would have to distinguish. So again, the same issue of the difficulty of TDS and the difficulty again here also, that if it is in kind, you are supposed to make sure that tax is paid. How do you make sure of that? That is something which remains uncertain. Then you have the avoidance provisions like bonus stripping and dividend stripping, which are extended. There's nothing really to discuss there. These are anti-avoidance provisions, and logically extended to make sure that they are not misused. I mean, these things are not misused. Then a change, however, on cash credits under Section 68. Another example of something which is being done, where you are basically saying, on the one hand, you say that the whole purpose of the finance bill, I mean, amongst other things, is to create an atmosphere of trust. And then what you are really saying is, we as the regulators, we as the income tax department cannot do our job. We are not sure we can really function. Therefore, we will put the burden on you. So what you are saying is, if you have received money from a certain source, and you are able to prove to me who is that person and who is the source, I will still add that item as your income, unless you can prove to me how the man who you say is the source, from where he got it and how he got it. Is it my job, or is it the job of the tax department? I am establishing to you from whom I have got it. He is confirming. I'm giving you his PAN, I'm giving you his Aadhaar, I'm identifying him to you. There is no debate on that. There is no uncertainty on that. Now, once that is established, it's for you, the assessing officer, assessing that creditor to determine whether he is liable to tax, not liable, and whether he has a source for his income or not. Why are you now putting less burden on the assessee? But you are putting it on the assessee. That is what the amendment to Section 68 is saying, that you have to establish source of source. Luckily, it is stopping there. It is not source of source of source of source. You can go on to say that. There is no limit up to which you can go. Money is fungible, keeps moving, and you are only saying source in the context of loan. Why not in the context of sales? I have sold goods. Somebody has paid me 1,000 rupees. Why do you not want to find out from where you got that 1,000 rupees to pay me the 1,000 rupees? It could be black money. If it is black money, he will pay tax on his income and you will catch him. But you can't ask me to do your job. Effectively, now, as a country, to some extent, we accept it. In GST, almost similar provisions are there. If you have an input voucher, which is proved to be false because that man has not paid, you have to pay the tax. Unfair. It's for the government to find out that input voucher, and if that man has given false input vouchers, catch him. Send him to jail. Do what you have to do. You can't really punish the recipient. But you are. And one more point, just which one may put it here. See the language which again the explanatory memorandum has used for this purpose. They have used the word creditor. Up to that is fine. Or entry provider. The assumption is almost every loan creditor is not a creditor, he is an entry provider. That is the assumption of the explanatory memorandum. And it does not even exclude loans from banks, NBFCs, and other regulated agencies. It says we have excluded venture funds and venture capital funds. That was excluded in the context of share capital. Now that you want to charge loans, exclude in the context of loans. Even that has not been done. Then coming to the provision for filing updated returns. This is another section which, complex section as to how, but it's more a procedural section. I will not take too much time on that. The long and short of this updated returns is, effectively, if you have not included some income in your original return, now the time available to file a revised return is very short. The total time is only 9 months from the end of the financial year. So effectively, you may not discover your error by then. If you cannot discover your error in those 9 months, you have 2 more years from the end of the assessment years. So really 27 months or 20, to be able to do this, within which if you discover your mistake, you can revise your return. But number of conditions to be able to do that, one of which is there should not have been an assessment in between. The area which is uncertain and which will remain an open area is 143(1) an assessment. Today the CPC has technologically been modified so well that if you file a return, often within an hour, the CPC processes the return and returns it back to you technologically after doing a 143(1). Now, if 143(1) is an assessment, then this 2-year window is not available to you. You can't hereafter use this additional tax window. So it may be in very few cases that this additional tax window will apply unless they clarify either by an amendment or by a notification that for this purpose 143(1) will not be considered to be an assessment. Then of course it may work, and then in that case assessees will examine, do I take the risk of it going to an assessment? Now 99% cases are not to be assessed. The return will be accepted. So then this income may not be assessed at all. If it is assessed and it's a genuine mistake and I am able to show that it's a genuine mistake, I may pay a 50% penalty under 270A, or I may not pay any penalty, depending upon the type of addition. So it could be 0, it could be 50, it could be 200. The assessee will now have to evaluate in his mind which of these 3 it is. If it is the risk of 200, naturally, he will choose to file the additional return, tax return, and pay a 25 or a 50% additional tax. But if he thinks he has a good case for 0, or he has a good case for 50, he will not do it. So this is an evaluation to be made. The reason why one would have been happier if government had given this 2-year window with all the same conditions, but without this additional tax. In the context of indirect tax, in the context of GST, you have the same window. If you file before a show cause notice is issued to you, it's only 15% of the penalty. After show cause 25, after order 50. And if you don't accept the order and you want to fight, of course you fight. You either win your case, you pay 0, or you lose your case and pay 100. That is the position. So then I think the similar rules, this additional tax seems to be excessive and uncalled for if your objective is to permit genuine mistakes to be made good. And if your objective is to allow income which was evaded to be made good, then this is fine. But I don't think that could ever be the objective. And that you have made clear is not your objective by saying cases of assessment, reassessment, cases where a notice under section 90 is issued, or cases where any other notice is issued, are all cases where you can't avail of this benefit. So that is not your intention. Your intention is genuine cases. Genuine cases, why should you want to charge additional tax? Interest you are charging in any case for the delay in payment. That's all that one should really be charging. Then you have amendments in relation to faceless assessment, which I think need discussion, and in amendments in relation to mergers, which also need discussion, and charitable trusts. These are the 3 areas which I thought we should discuss, if not the others. As far as faceless assessments go, you are replacing that section, but continuing the procedure, and it is perhaps an extraordinary innovation which India as a country is doing, and which is achieving. If it really works, it's really going to make life easy for assessees. If you can be assessed faceless, if you don't have to appear, I mean, that's a major hassle which is gone. You don't have to worry. You can sit at home, get a notice, reply, and that's the end of it. And your no reply will go by whatever documents are required. You will furnish if they are required to be furnished. That's all. So in that sense, it's one of the best processes which will work. The negative is where there is a disagreement between the tax department and the assessee. In that case, natural justice demands that the assessee be heard, that he should be given a chance. And that chance is not merely a faceless chance, because there is a big difference between putting forth your arguments in writing or otherwise, but in a faceless manner, to a person whom you don't know and whose reaction you cannot judge. That is not an effective way of putting forth your position. You are not able to explain to him why what you are saying is right. And why what you are saying is right may involve questions of law, may involve complex questions of fact. And they will not go across in a faceless assessment. That is why you need to be heard. That is why the universally accepted component concept is that natural justice requires a hearing. Now you have amended the law to say it's up to you. If you feel that the case is so complex, if you feel that your case involves such a question of law which you need to explain, then you are free to ask for a hearing. And if you ask for a hearing, you will get it. The only restriction being it will be by video. That's fine. Technology has improved. Video conferencing today is as good as sitting across. I am speaking to you today without any physical meeting. Technology is allowing us to do that. So why not video conferencing for a faceless assessment? So that's fine. So that is what it provides for. The difficulty is in the drafting. The entire procedure is set out in what is subsection 1. The reference to the hearing, the video hearing, is in subsection 6, not in subsection 1. Subsection 1 in all the steps which it talks about. It talks about the assessing officer looking at it, internally dealing with a verification unit, dealing with a technical unit, then giving you some indication of what he thinks needs to be disallowed and giving you a chance to show cause. You're showing cause, he's dealing with your reply, and then again making a draft assessment order and so on. There also I have one issue, namely after the draft order, he is allowed to get it reviewed by a review unit. Post the review, there is no second show cause notice provided for. It's a question mark that if the assumption is that the review unit can only be for the benefit of the assessee, and the review unit cannot suggest an addition further or a further strengthening of the assessment order, then that's fine. Then there is no need for a further hearing. But if the review unit is something who can strengthen the assessment order or can add to the assessment order, then there has to be a further hearing. Because in that case, that point on which the review unit now says that the disallowance is justified. He had given you 3 reasons why he was proposing a disallowance. You replied to them in the show cause notice. The review unit has given a 4th reason. You never had a chance to reply to that 4th reason. It should not be allowed to go through. So that's one. But throughout subsection 1, there is no reference that you can, when you get the show cause notice, ask for a hearing. That comes up in subsection 6. In subsection 1, the show cause notice is supposed to contain with it an indication of the areas which he wants to add. No draft order, no draft assessment proposal. That is not referred to in subsection 1. In subsection 6, the hearing is given in the context of a show cause notice for a draft assessment order or for a draft proposal. But you never have a draft proposal under 1. You never have a draft assessment order under 1. You don't have a show cause notice for that. So 1 and 6 are not talking to each other. Subsection 1 and 6 are not in line, not in sync. In that case, whether 6 and the hearing which it is providing for will function is unknown. And if it doesn't work, then 1 doesn't provide for a hearing, so you come back to square 1. This procedure will again be questioned on the grounds of natural justice. The drafting should have been a little more careful. If the intention was that you will give a hearing wherever requested, I think what is now put in subsection 6 should have come in 1, and the procedure should have been specifically clarified. Similarly, subsection 1 does not deal with and does not clarify how it is going to deal with transfer pricing. Whether you will send it to the TPO or not send it to the TPO, and so on. You are going to send it. If you send it to the TPO, will it be a violation of subsection 1? I would think it may be. Subsection 1 in categorical terms says, notwithstanding anything contained in any other provision, you must do the assessment by this provision. So then if sending to the TPO is contrary, it is wrong, then you have failed. Now there is no subsection 9. That is gone. So the provision which said it was non-est is gone. Fine. But if one says that you will do it this way and you don't do it that way, then it is non-est. I don't need a subsection 9 to say it is non-est. You have any number of decisions of any number of courts which say that if a law prescribes that something is to be done in a certain manner, it must be done in that way and in no other way. So if the law specifies that assessment is to be made as per following subsection 1, and it does, it can't be done any other way. By removing subsection 9, you cannot make non-est assessments into proper assessments. What will be the difference? The difference will be cases where the assessing officer is able to show that the failure in procedure of subsection 1, the small error, if any, which occurred, was not one which caused any prejudice to the assessing, was only a technical failure, was not a substantive failure, and therefore the assessment should not be considered non-est. I think any court would accept that, if he is able to show that. But he will have to show that it caused no prejudice. If he sent it to a TPO and he has suggested additions, it caused prejudice. If he sent it to a review unit and the review unit said, give a fourth reason, it caused prejudice. If he sent it to a technical unit and they gave some interpretation of law contrary to what the assessee is claiming, it caused prejudice. And therefore, if those things have happened contrary to procedure, it has caused prejudice. If he failed to send it to a technical unit when he should have sent it, and therefore did not get the benefit of advice, which would have told him that this provision of law is correctly claimed, then also it has caused prejudice. So therefore, by removing subsection 9, I don't think they are achieving that non-est assessments will become proper assessments. Subsection 1 remains what it is. It remains an enforced section. What will be the effect in respect of those assessments which were non-est in the last 2 years will therefore have to be judged now on 2 principles. One, is the retrospective amendment of subsection 9 valid? And because of that, just because that is removed, does non-est become est? Or even now, it still is necessary to examine whether subsection 1 was followed properly. And if it was not followed properly, they will remain non-est. And this is another amendment which where again the department is effectively saying, we will not do our job. We may make mistakes in following the procedure. If we make mistakes, we should not be punished. We had originally agreed that we will be punished. Our assessment will be honest. Now we don't want that punishment. So this subsection is removed retrospectively from the day it was introduced. The department cannot be punished for the mistakes it has made in following the procedure. Assessee, if he has made a mistake in filing the return, he must pay additional tax of 25 or 50% and file the additional return. So that is what the finance bill is effectively saying. Then coming to the amendment on in relation to mergers, business reorganization as the phrase is now used. The section uses the word amalgamation, merger, demerger. Seems to be a mistake. I don't know why it uses both the words amalgamation and merger, because both mean same, and normally legislature does not use two words where one is enough. There is no tautology. So we must try and imagine what is a merger distinct from an amalgamation. And I think what it means is a non-compliant amalgamation. If you have an amalgamation of two companies, but you don't satisfy subsection 2(1)(b), 75% of shareholders don't become shareholders, yet there is a merger, then you are still calling it a business reorganization. So it will be covered here. So it deals with amalgamation, merger, demerger. What it says is any assessment made in the period when the business reorganization is pending and includes any proceedings taken, not just assessment made, will be valid as if they have been done against the successor. Now, true in the context of amalgamation and merger, if the appointed date is such that from that day everything belongs to the successor, that's fine. In other cases, that's not fine if it doesn't belong to the successor from the appointed date. So that is one. In a merger, it may or may not belong to the successor in a non-compliant one. And even in a compliant one, it depends on the appointed date. Pendency is very different from appointed date. So that is going to create some difficulty. But that is fine for proceedings and assessment in the context of this. But in a demerger, the assessment is on the demerged company on its entire income. That assessment can't be on the successor who is taking only one division of the demerged company. So this can't apply to a demerger, but they have applied it to a demerger. That seems to be an error that will perhaps need rectification when the bill is passed. By then, perhaps demerger will be removed. It will refer to amalgamation or merger. I think it should refer to only those cases where pendency starts with the appointed date. So that from that day onwards, if and when the reorganization is allowed, the entire transactions, profits, income belong to the successor. In those cases, this would be a valid provision that these proceedings are on the successor. The intention behind this is not that. The intention is we may make an assessment in the name of the predecessor even though we are aware of the reorganization, and after that the courts have told us that because we have made the order in the name of the predecessor, we can't recover the money. That is unfair. We should be allowed to recover the money even though we made the mistake of making an order in the name of a dead man. That is the intention. That is not proper. I think the proper thing would be this much, if this is all that they seek to achieve. So one needs to see how this section will actually unfold. The second part of that section is giving a power, 170 capital A, the power to the resulting company, the transferee, to file a revised return. It's in line with what the Supreme Court permitted in Dalmia's case, that once the reorganization is approved, you should be allowed to file a revised return even though the due date for that is gone. The time has expired. Here you now have a new lease of life. You are given 6 months from the day on which the order is passed. But what you are allowed to do is a modified return. So now you have normal returns, you have revised returns, you have updated returns, and you have modified returns. You have 4 types of returns under the Act, and each type of return will have its own consequences. Questions will be for modified returns. What happens when an assessment is already done, not done? Are you allowed to combine profits? For doing that, are you allowed to prepare fresh accounts? It seems to suggest yes. So your MAT liability will depend on the fresh set of accounts which you have compiled. But to suggest, doesn't say it in so many words. Seems to suggest from the explanatory memorandum, not from the section. So again, gray areas on the modified return, which we will have to deal with. And finally, coming to charitable trusts, a major area where there is tremendous thirst in this particular in this finance bill. Some very good provisions, some a little more difficult, but broadly acceptable. A new procedure which is being prescribed, one would say, for charitable trusts. It's more procedure, not so much substantive change. Not really. One major substantive change is if money is received for repairs and renovation of a temple by a notified temple, then that money can be treated as a corpus donation. And therefore, you need not spend it within that year or within 5 years. Even that 5-year condition, which is otherwise available, you need not spend it. One doesn't know why it has been introduced. If money is received for repair or renovation of a temple, 99 out of cases in 5 years, you should complete that repair or renovation. You don't need to make it a corpus donation and keep it. And if you use it up in 5 years, you should be okay. You don't need this amendment. But the concession has been given. It's a concession. One doesn't lose anything in taking concessions. So it's welcome. It's good. It has no negative side to it. Whether it was required or not is a different matter. Otherwise, you are putting sections under 1023C and 11 on par. Broadly, that's also fine. That's also not a very material change. The main change is the extraordinary power to withdraw registration in a variety of circumstances, including for failure to comply with the conditions of registration. This extraordinary power is given on the assumption that commissioners of income tax will act fairly and reasonably. And like we mentioned in the context of faceless, that if it's a technical or venial breach, it will not become non-est. If it's a substantive breach, it will become non-est. Similarly, if you have substantially violated, registration will be withdrawn, not otherwise. But it's, in the context of faceless, it is not stated in the law. In the context of registration, it is not stated in the law. How it will actually be used, we don't know. And if it is misused, it can create significant problems for charitable trusts whose registration is withdrawn and who therefore become taxable on their entire income. Well, thank you so much for having heard me so patiently on this finance bill.
Yes, sir.
Hello. Able?
Sir will be back in a minute.
Hello. Yeah.
Hello.
Scholar, sir.
Yes, sir. You can please proceed.
Yeah. No, I have.
Sure. Sir, it was uh, the thread-bed analysis. What you have done is indeed remarkable. There are many finer points which were not known to many of our members, because the way in which the bill was drafted and the hidden points which were there, you have analyzed those in a very critical manner. I'm sure the experience what you have and the way in which you have analyzed linking the uh, clauses with other clauses and the intent behind the legislature has been discussed by you at length. Also, your point regarding uh, the mistakes or errors committed by assessing officer are now has been what we can say amended so as to penalize only the taxpayer and to charge them additional tax by way of different names. So sir, it was really a wonderful session, and I'm sure all the members present over here had a very good learning and has understood the bill in a very lucid language, and your experience had really made this presentation more effective and more better. So thank you. I, on behalf of WIRC entire team, we express our deepest gratitude to you for enlightening our members on this direct tax bill. Thank you very much, sir.
Thank you. And thanks to all the participants.
Thank you, sir.